Have you ever felt compelled to buy a stock just because it's gone viral? Well, that's what meme stocks are. So, should you buy meme stock? Here are some things you need to consider now that they're back in the news. Shares of GameStop surged to an 18-month high in May after stocks influencer Keith Gill, more commonly known as Roaring Kitty, posted a cryptic meme. GameStop is considered the king of meme stocks, stocks that see their prices heavily influenced by social media and online communities. Viral posts about these stocks can push up or push down prices.
Back in 2020, there was this guy, Keith Gill. He started to produce videos about a particular stock that he actually liked, which was called GameStop. These videos actually came out, and then he was just talking about how undervalued they were. The whole Reddit community basically jumped onto it, and it went viral. All of a sudden, the stock price went from $5 to $50 over a span of a few weeks, and then all of a sudden in January, the whole price went from $50 to almost $500.
And that kind of volatility is how you can tell a meme stock from a traditional stock. During the last meme stock craze, GameStop went up nearly 700% before crashing. So, is history about to repeat itself?
So what happened back then was, in 2021, there was a massive surge in these stocks. The rally was actually primarily driven by retail investors, with the goal of driving up the price to initiate a short squeeze. So what happened when there's a short squeeze? It would actually force the short sellers to buy back to cover the short position, whereby further driving up the price even more. So in the middle of this, the market experienced extreme volatility. Brokerages around the world actually implemented some forms of trading restrictions in trading these names. So at the end of the saga, when the music stops, extreme volatility eventually dies down. Then we actually see the prices collapse. So what's the aftermath? We actually see there's a lot of gain and financial losses by many.
Other meme stocks that saw volatility included cinema chain AMC, BlackBerry, and home retailer Bed Bath & Beyond. Shares of Bed Bath & Beyond have been delisted.
So what happens when a share is delisted? It is actually deemed as worthless. So there's no avenue for the investors to actually liquidate the shares, which actually caused them to have a total loss on the entire investment.
Compared to the original meme stock craze in 2021, there are key differences this time around. For one, trading volumes in GameStop shares, for example, are not as high compared to 3 years ago.
So back in 2021, we are still in the COVID pandemic era, which forces people to be at home, thereby having the spare time to trade. And also back then, right, trading is made more accessible because of the numerous mobile trading app. Then back then, the market conditions is also different. We are in a low interest rate environment. And the government and central banks around the world actually injected massive amount of liquidity into the economy. So fast forward to 2024. We are in a very different environment right now. So it actually serves as an alternative for the investors to actually park their excess cash with. Second, people are returning to their normal duties. So with the returning to their normal duties, right, people have actually less time to spend on speculative trading.
But there's one thing that hasn't changed. Experts agree that meme stocks are highly risky.
If they really want to invest in a meme stock, they must have a very big heart. Because for meme stocks, the kind of fluctuation is what you will not experience in any other stocks in the market, like the normal, like for example, like banks in Singapore is very stable. You only know that the price will go up and down, like maximum like $5 in probably in a year. And secondly, they cannot just rely on the markets to continue go higher because people will exit market at very unexpected timings. So sometimes if you just follow the market hype, you are just being trapped inside because when you want to exit, the market has already come down a lot. It's much lower than your entry price.
So if you are still thinking about trading in meme stocks, right, our advice is to think of it as speculation rather than long-term investment. So when you are speculating something, you will not want to be putting your entire savings into this. So when you're speculating something, you will tend to be putting the size of the money is that you can actually afford to lose and not touch on the emergency funds or your retirement savings. Then on the psychological side, right, you must be prepared to lose your entire funds that you actually put in for speculation.